In this video, I'm going to be reviewing various mutual funds, specifically ELSS mutual funds that you can claim as ATC deduction while filing your returns. Hey guys, welcome to Vision Shares. My name is Karthik Kulkarni and today I'm going to be talking about Quant Tax Plan Direct Growth Mutual Fund. Now this is an ELSS mutual fund. ELSS means Equity Linked Saving Scheme. Now you can only claim an ELSS mutual fund as deduction under ATC. So I'm going to be reviewing this mutual fund and every other mutual fund in the coming days. So the main features of ELSS mutual fund is that it has a 3-year lock-in period, but the minimum investment and the returns that come from these mutual funds differ. So that is what I'm going to be talking to you about in these videos, and I'm going to be rating them out of 5. The Con tax plan has a minimum SIP of rupees 500, and as reported by them, they have a 1-year return of 9%. They have a 3-year return, average returns of 39.7% and average return in 5 years of 22.5%. Now this is the 1-year, 3-year and the 5-year returns. Since the mutual funds have started, the average return of all those years they have given as 21.1%. So 20% returns from the beginning is actually very good for an ELSS scheme because it is not as risky as normal equity mutual funds. So 20% is very good. Now let's get down to the technical aspect, that is the ratios that they are given. I will explain in very brief what this ratio is supposed to mean. I will only be telling you whether the ratio should be high or whether the ratio should be less. So let's talk about the P ratio. Now P ratio is decided when you divide the current market price of the stock and you divide it by the earnings per share. Now the P ratio is supposed to be high. The higher the P ratio is, better it is for a mutual fund. So for Con tax plan, the P ratio is 20.32, which is quite high compared to the other mutual funds in the list. There is also called a ratio which is called the PB ratio. Now the PB ratio is supposed to be high. The higher the better. So the Con tax plan has a PB ratio of 2.23. Then comes the alpha ratio. Now the alpha ratio is a ratio that is calculated to see how it has performed according to a benchmark. Now benchmark means a standard, मतलब एक level है, ठीक है. If the alpha ratio is above this level, it means that it has outperformed the level or the benchmark, and if it is in minus, it means that it has underperformed the benchmark. So for example, if the alpha is 1, that means the mutual fund has outperformed the benchmark by 1%, and if it is -1, then it has underperformed the mutual fund benchmark by 1%. The Con tax plan has a alpha ratio of 18.09. So this means that Con tax plan has outperformed the benchmark by 18%, which is actually very good. Then there is the beta ratio. The beta ratio talks about the volatility of the mutual fund. So less the volatility, it is the better for the mutual fund. So the lower the beta ratio, it is better. It is considered as good. So the Con tax plan has a beta ratio of 0.95, which is actually good. The Sharpe ratio is supposed to be high, but high also means higher returns and also high risk. So higher the Sharpe ratio is, it means that it is giving you good returns, but also it comes with a good amount of risk. So 1, 2, 3 or even more than 3 is considered to be a high Sharpe ratio, but it also means a good return and good risk. So Con tax plan has a Sharpe ratio of 1.4. Last but not the least, there is a Sortino ratio. The Sortino ratio is supposed to be high. It is said that the Sortino ratio with a ratio of 2 or more is considered as good. So the Con tax plan has a ratio of 1.67. Now let's get down to the return calculator. Now I will be showing you exactly how much returns you would be making or you would have made if you had invested in 1 year, 3 years or 5 years. Now, all the investment platforms have a return calculator. They tell you how much you would have made if you had invested per month or per year, and they also tell you the returns that you would have got in those years. As you can see, if I put 5,000 per month and with a 1 year category, we get a total investment of 60,000. That is 5,000 into 12 months, which is 60,000. It would have become 63,860, which is a 6% return. If you had invested for 3 years, that is 5,000 per month for 36 months, it would have become 1,80,000. That is your total investment. And with the returns, it would have given you 65% returns, and your total would have come to 2,97,000. And the same if it was invested for 5 years, you had invested 3 lakh rupees, and this mutual fund would have given you 111%, which is 6,35,000, which is quite good. In 5 years, you are getting 100 above 100% returns, which is very, very good. For an ELSS mutual fund, Contax plan seems very good and definitely worthy of the 4.5 rating. So 4.5 out of 5, I would give this, because the minimum investment amount is 500. It has given positive returns all over these years, even in COVID, including COVID, it has been giving positive returns, and 100% returns in 5 years is actually very good. So I will be seeing you all soon in the next video, where I will be talking about the Mirai Asset Tax Saver Fund Direct Growth. If you like this video, please subscribe to the channel, like the video, comment your opinion. If you want me to review other mutual funds, you can comment that too. I will definitely make videos for what my viewers expect from me. I hope to see you soon. Take care.